Imagine you're running a fast-growing startup. You're adding thousands of customers a day, investors love you, customers rave about your product, you hit unicorn status, and everything looks perfect. Then the regulator walks in and says, you may have onboarded 34,000 high-risk customers without even knowing it. That's Monzo, a digital bank that exploded from a tiny UK fintech to over 12 million customers, and just got hit with a £21 million fine in the UK for failing to have even the basic of money laundering controls. We're talking about thousands of accounts onboarded without proper checks, risk ratings that were skipped or autofilled, and suspicious behavior going undetected for years. This is what happens when the pressure to scale fast leads to taking the wrong shortcuts, and building products become more important than building trust. So in this video, I'll break down what really went wrong at Monzo, the 5 major AML failures that costed millions, and how to spot and fix these gaps. Monzo looked like a success story from outside, but underneath, their systems just couldn't keep up with their growth. And that's the key lesson here. Before you scale, you need to make sure that your systems can scale too. Not just your app or user base, but your risk, controls, documentation, and decision making. Let's get into it. I'm Kevin. I've been in risk and compliance for over 15 years, from head of audit in banking in New York to chief risk and compliance officer at a fintech in Europe. So let's do a quick recap. Monzo started in 2015 as a mobile-only bank in the UK. With their bright coral debit cards and sleek app, it quickly became the poster child for how modern banking should look. By 2019, Monzo became a unicorn, valued at over £1 billion British pounds, and by 2024, it had over 12 million customers. But what regulators found was that while the front end scaled beautifully, the back end, and specifically Monzo's anti-money laundering or AML compliance systems, didn't grow at the same pace. And that's the heart of the problem. Now, let's look at a different timeline. So in 2018, Monzo's AML officer leaves. This role goes unfilled for over a year. Between 2018 and 2020, Monzo scales rapidly, but internal AML checks fall apart. And in 2020, the FCA steps in, or the UK Financial Conduct Authority, the UK regulator. Monzo promises to fix things, but continues onboarding thousands of high-risk customers anyway. And then in 2025, the UK's Financial Conduct Authority, or FCA, issues a final notice. £21 million fine, citing serious AML control failures. So the FCA outlined 5 core areas where Monzo failed. So number 1 is broken risk assessment at onboarding. When a customer signs up for a bank account, one of the most important and legally required steps is conducting a risk assessment. This is the point where the bank decides, is this customer low risk and suitable for streamlined onboarding, or are there indicators that suggest that we need to look deeper before we hand over access to the financial system? At its core, a risk assessment assigns a risk rating, usually something like low, medium, or high, based on data points such as your job or income level, your country of residence or nationality, whether you frequently use cash or crypto, your source of funds, and even your personal relationships. For instance, if you're related to a politically exposed person or a PEP, like a government official, that's a red flag under AML laws. This rating then determines how much due diligence the banks need to perform. So low-risk customers may just need a basic ID and address checks, whereas high-risk customers may require what is called an enhanced due diligence, or EDD, which is additional verification and closer monitoring over time. But in Monzo, the foundational step, the risk assessment, completely broke down. They used a tool internally to collect this data and determine risk scores. But according to the FCA, in thousands of cases, this form was never filled out at all. In others, it was completed only after the account was already open, meaning that the bank made a decision to onboard the customer without knowing the risk profile. And worst of all, in many situations, the form was automatically overwritten with low-risk default, regardless of what the actual data said. Let me give you a couple of real examples from the case file. So someone listed their home address as 10 Downing Street. That's literally the UK Prime Minister's residence. Another used the address of Monzo's own office headquarters. Neither of these were flagged. There were no alerts, no blocks, no follow-ups. These accounts were onboarded like anyone else. So why does this matter? Well, risk assessment isn't just a regulatory checkbox, it's a filter that prevents your entire AML program from falling apart. If you mislabel a high-risk customer as low risk, they won't be monitored properly, they might never be reviewed again, and they could use your platform to launder money without you ever noticing. On the flip side, if you label too many customers as high risk when they're not, you waste resources reviewing people who don't need that level of scrutiny, and you create an operational drag and poor user experience. Getting this balance right is the heart of AML compliance, and Monzo's failure shows what happens when that system is left to chance. They grew too fast. They prioritized user acquisition and seamless onboarding, but the underlying controls, the actual gatekeeping, weren't ready. And when you onboard hundreds of thousands of customers that quickly without knowing who they really are, it's only a matter of time before something goes wrong. So, how do you avoid this? Well, first, I would make risk assessments mandatory before onboarding is finalized. So, no account should go live until the system has a valid risk score in place. This isn't just best practice, it's actually a regulatory expectation. Second, I would build systems that block account activation if key risk fields are missing. Sure, there may be rare cases where manual override is necessary, but make that the exception, not the rule. And every override should be logged, approved, and reviewed later. Third, I would add logic to flag clearly fake or suspicious data. Think about known VIP addresses like the White House, Buckingham Palace, or impossible dates of birth like someone claiming to be 250 years old or 6 months old. These should trigger automatic rejection or escalation. Fourth, document the process and enforce it. So if your risk assessment policy only exists in theory or as a PowerPoint in someone's SharePoint folder, that won't save you. Tie the policy to your onboarding system logic. Audit it, test it, and update it as your customer base evolves. Because at the end of the day, your entire AML program depends on the first decision. Who are we letting in and how risky are they? If you get that wrong, as Monzo did, then everything that comes after is built on a shaky foundation. So the second was weak customer due diligence and missing enhanced controls, or CDD and EDD. So Monzo didn't consistently collect or verify basic information like a customer's occupation or source of income. So a 58-year-old could claim to be an active professional athlete earning millions playing for a well-known sports team, and no one would raise an eyebrow. The purpose of the accounts, which is crucial for banks to know as it tees up the monitoring of the accounts, whether they were a politically exposed person or someone at higher risk of corruption or financial crime. And for high-risk customers, banks are required to do the enhanced due diligence or EDD, which means a deeper verification and monitoring. But Monzo missed many of those too. So to fix this, I will create a clear playbook. What information is always required? What triggers EDD? And what considers a red flag? This is really basic stuff. I would use tiered onboarding flows, so let low-risk customers move faster but force manual review for riskier or high-risk profiles. And most crucially, audit your onboarding flows and conduct regular manager or peer reviews. Just because your checklist exists doesn't mean it's being followed. And again, document it all. If you ever need to prove that you did the right thing, your documentation is your shield. The third was inadequate transaction monitoring. So even after accounts were open, Monzo systems didn't catch enough suspicious activity, and when they did, there often wasn't a follow-up. So we're talking about accounts being used as money mules, i.e. receiving and immediately sending funds in patterns consistent with fraud, unusual transaction patterns like large crypto inflows followed by quick withdrawals, and high volume transfers from newly opened accounts. So to fix this, you could use a mix of automated rule-based monitoring and machine learning to flag outliers. But automation isn't everything. You also need trade analysts reviewing flags with context. I would also set clear thresholds and escalation paths, and file SARs or suspicious activity reports when required. Many of Monzo's SARs were delayed or never filed at all, which brings us to the next point. Poor suspicious activity reporting, or SAR. So SARs are how banks report potentially illegal activity to the authorities. But Monzo delayed filing them, didn't escalate suspicious patterns internally, and sometimes missed the need to file altogether. This often comes down to the process design and training of the team. So to fix this, they should create a decision tree for when a SAR should be filed, designate clear ownership on who reviews, who escalates, and who submits, and don't forget staff training. Everyone from customer support to engineers should know what suspicious behavior looks like in your context. Again, your process only protects you if it's followed and logged and documented. So the fifth point that the FCA brought up was that the compliance team was under-resourced and governance was lacking. So for over a year, Monzo did not have a permanent MLRO, or the Money Laundering Reporting Officer. That person is legally responsible for overseeing the day-to-day AML controls being carried out and reporting any issues to banks' management and regulators. On top of that, the compliance team wasn't staffed to match Monzo's growth. Risk wasn't embedded in product launches, and control ownership was unclear. So to fix this, you would appoint a dedicated MLRO early, someone with actual decision-making power and experience. You would embed compliance into product teams, not just legal, but risk thinking. Most importantly, map your AML framework, such as who does what systems do you use, what gets reviewed, when does it get reviewed, and things of that nature. Whether you're an established bank, a challenger bank, a neobank, or even a crypto exchange or payment startup, here's how to keep your name off of the regulator's front page. So first, build your AML framework early and scale it with the business. Don't assume that what worked with 1,000 users will work with 10 million users. Lay the foundations right so that when you do scale, you don't have to reinvent the wheel every time you hit a significant milestone. You can just add an additional layer to what's already working, while also gather all the information you can to align your framework with new developments and best practices. So one of the best advices that I could give you is to regularly review reports that your regulator files. There you can find AML trends and what other banks or fintechs are experiencing, and you can use that to update your own AML framework. And if you're ever unsure about something, don't hesitate to have a conversation with your regulators. They're usually there to support you, not to catch you out. Also, document everything: your onboarding process, risk scoring rules, transaction monitoring thresholds, escalation paths. When regulators knock, your documentation is the first thing that they look at. If they're happy there, chances are that they'll be happy later as well. Test your controls regularly, so don't wait for a regulator to tell you your system is broken. Run simulations, do internal audits, challenge your own teams, and use your learnings, new developments, and best practices to improve what you're doing regularly. Look to regulation earlier rather than later. So if product can push out a new feature overnight, but compliance needs 3 weeks to review it, something's off. Include compliance or regulatory experts early. The regulation is usually right there. There's no need to have that to be the last point at the checkoff. And the fifth will be train everyone. Not just your compliance team, but engineers, product managers, and even marketing should understand basic AML risks. At the end of the day, AML compliance is not just about checking boxes, it's about protecting your company from being used to commit financial crime. So to recap, Monzo didn't deliberately help criminals, but they created the perfect environment for bad actors to slip through. By skipping risk assessments, failing to follow up on red flags, and underinvesting in governance, they turned what could have been a fascinating growth story into a cautionary tale. Now, what this case shows is that growth isn't the enemy, but sloppy growth is. So take this case seriously. Use it to challenge your current setup, and if nothing else, remember this. In compliance, what saves you isn't being perfect, is being able to show that you had the right processes, that you followed it, and improved when things went wrong. If you got value from this breakdown, give it a like and share it with someone in risk or fintech or banking. And let me know in the comments if there's any other case you would want me to cover as well. Thanks for watching. I'm Kevin. Thanks.
Honestly, I don't think there's a better digital banking app out there than Monzo.